300 years before Western banks existed on this continent, a woman, none of us can name, held more financial power than most kings. She had no vault, no guards, no coins made of gold. What she had was something far more dangerous and far more valuable. She had your word and you had hers. In the markets of West Africa, long before the first European ledger touched African soil, women were running something that looked impossibly like a bank. No building, no paperwork, no interest rate printed anywhere, just memory, reputation, and an unspoken rule so powerful that breaking it could end a family's future in that market forever. Historians call it informal credit. The women who ran it called it something simpler: trust. And what they built with it quietly, for centuries, without a single Western economics textbook, was more sophisticated than most people realize. This is the story of how African women invented the credit system to the modern banking world still pretends it discovered. To understand how this began, you have to understand the problem these women were solving. Picture a market in the Sahel, Kano, Timbuktu, or a coastal town along the Gold Coast, sometime in the 1600s or 1700s. Goods move through these markets constantly. Salt from the desert, cloth from the coast, cola nuts, gold dust, dried fish, grain. But here is the problem nobody talks about. Most traders did not have enough capital to buy an entire shipment of goods outright. A woman selling cloth might need 40 bolts of fabric to make her trip profitable, but she only had money for 15. In a modern economy, she would walk into a bank and ask for a loan. But there were no banks. Not the kind we know today. So West African trading communities built something else instead, something economists would not have language for until centuries later. They built rotating credit associations. In parts of Nigeria, they were called Esusu. In Ghana, Susu. Among Hausa trading networks, credit flowed differently, but on the same principle: trust reinforced by shared community, shared religion, shared consequence. Here is how it worked, stripped down to its simplest form: a group of traders, often women. Since women dominated many West African market systems, would each contribute a fixed amount into a shared pool on a regular schedule. Every cycle, one member of the group received the entire pooled sum. Next cycle, someone else. Everyone paid in. Everyone eventually received a lump sum large enough to actually change their business. No interest charged, no collateral required, no written contract. Just one condition: you did not default, ever. Because if you took your turn with the pooled money and then vanished, if you broke that cycle, you were not just losing a business relationship. You were being erased from the market itself. Word moved through these trading communities faster than any modern algorithm. A woman who defaulted in Kano could find herself unable to trade in Sokoto within a season. The system had no police force, no courts, no collections agency. It didn't need one. Reputation was the collateral. And reputation, once destroyed, could not be rebuilt with money, only with years. This was the beginning, not a bank building, but a belief system so strong it functioned exactly like one. Once this system existed, something remarkable happened. Wealth that had been locked outside people's reach, capital too large for any single trader to access alone, suddenly became reachable. Consider what this actually unlocked. A woman who could only afford 15 bolts of cloth could now access enough capital through her rotating credit group to buy 40. 40 bolts of cloth, transported and sold correctly, might yield profit margins that 15 bolts never could not, because the math scaled evenly, but because larger volume let her negotiate better prices at the point of purchase and reach markets further away where scarcity drove prices higher. This is the same principle that would later be called leverage by Wall Street bankers wearing suits nobody in Kano had ever seen. West African market women had already been using it, just without the word and without the interest rate attached. But the genius of the system went further than simple lending. The Hausa trading diaspora merchants, who moved along trade routes stretching from the Sahara to the coast, built something historians now recognize as one of the most sophisticated pre-modern trust networks anywhere in the world. A Hausa trader, arriving in an unfamiliar market hundreds of miles from home, did not arrive as a stranger. He stayed with a landlord, a fellow Hausa trader already established in that city, who vouched for him, introduced him to local buyers, and extended him credit based purely on shared identity and shared religious community. This reduced what modern economists call information asymmetry, the risk that comes from not knowing who you're really dealing with. In Lagos boardrooms today, companies spend millions on credit bureaus, background checks, and legal contracts to solve this exact problem. These trading networks solved it with something that cost nothing: shared community, shared consequence, and a reputation system so effective it moved faster than any modern data system. Meanwhile, in the great trading kingdoms further south, among the Asante of what is now Ghana, women rose to formal positions of economic authority that had no Western equivalent. Market queens, known as ohema in some systems, did not simply trade. They regulated entire markets. They set prices. They resolved disputes between traders. They controlled access to trading spaces and enforced the very credit customs that made large-scale commerce possible. This was not informal power exercised quietly at the margins. This was recognized, structural economic authority, women running the operating system of entire regional economies, centuries before a single woman held comparable formal power in most of Europe. The rise was not an accident. It was engineering. Financial engineering, built from trust instead of paper. Then the ships arrived, and everything the system had protected against, betrayal, broken trust, catastrophic risk, arrived with them. European trading companies did not understand the credit systems they encountered, or worse, they understood them well enough to exploit the parts that could be exploited while destroying the parts that could not. The transatlantic and coastal trade economies that Europeans built along the West African coast operated on entirely different assumptions. Where indigenous systems relied on long-term reputation within a stable community, the new colonial trade economy often rewarded short-term extraction. Traders and companies could make enormous profits in a single transaction and disappear, sail away, with no market to return to, no reputation to protect, no community that could ever hold them accountable. The entire foundation of the indigenous credit system, the idea that betrayal has consequences because you will need this community again, collapsed the moment ships could simply leave. This was the turning point. And it was not a single dramatic betrayal. It was worse. It was a slow poisoning of the trust economy itself. Colonial administrations, once formal rule was established, imposed European-style banking and currency systems that had no room for informal credit networks. Rotating credit associations were not illegal exactly, but they were treated as primitive, unsophisticated, unworthy of the same legal protection given to European-style banks and contracts. Colonial courts recognized European debts. They did not recognize the unwritten obligations of an Esusu circle. Access to formal credit, real bank loans, backed by colonial legal systems, was overwhelmingly extended to European trading firms and, later, to men positioned within colonial commercial structures. Women who had run entire market economies for centuries found themselves locked out of the very financial institutions that colonial rule declared to be the only legitimate form of finance. The market queens who once set prices for entire regions were recast in the official colonial record as small-scale traders, informal, unofficial, beneath serious economic consideration. The irony is almost unbearable when you sit with it. The same trust-based systems that had financed trade across an entire continent for centuries were dismissed as primitive by economies that would spend the next 100 years trying to reinvent clumsily, expensively, through microfinance, NGOs, and development banks, the exact thing they had destroyed. The turning point was not a crash, it was an erasure. The women who built this system were written out of the history books, but the system itself was never destroyed. It went underground, it survived, and in part 2 of this story, we uncover exactly how it worked, the mechanics, the peak, and the astonishing way it still runs quietly beneath the modern economy today. Because the most dangerous thing about erasing a system is forgetting that someone might rebuild it. This is African Wealth Stories. Part 2 is coming.